Assalamualaikum and good day everyone. I am Miss Basira and today we are going to learn chapter 4 for corporate finance, which is the cost of capital. Before we go any further, let's look at the learning outcome first. We have 5 outcomes altogether. The first one, you should be able to explain the cost of equity, cost of debt, and overall cost of capital for a firm. Secondly, you need to be able to calculate the cost of equity using dividend growth model and CAPM. So we have two models here. You need to be able to apply both model in computing the cost of equity. The third outcome is to calculate the cost of debt and determine weighted average cost of capital or weighted marginal cost of capital to derive the overall cost of capital. Fourthly, evaluate WACC to be used in investment appraisal. And lastly, you should be able to apply CAPM, CAPM in determining specific cost of capital. So for this video, I will only focus on the first two outcomes, which is the cost of equity and how to compute it using dividend growth model and CAPM. Here is the chapter's outline. As mentioned before, for this video, for the first part, I will only focus on the cost of equity. It is only parts of the cost of equity. The rest of the chapters will be explained in the next video. So what is cost of capital? When you want to define the cost of capital, it is always useful to look at from borrower's point of view, which is the organizations or the company, and we're also going to look at from the lender's point of view, which is the investors. For the organization who borrow the capital in order to finance the project, the cost of capital is the cumulative rate of interest. Usually it derives as an average rate combining all capital inputs applied to the borrowed capital to fund a project. So we can see that cost of capital is important for a company because a company wants to ensure they made a quality investment decision. A company needs to look at for optimal mix of financing which can provide adequate fundings and at the same time can minimize the cost of capital. Looking at investors' point of view, cost of capital is the relative required return rate considering the risk of the investment being made. It is the return expected by the investors to compensate the risk that they take in order to invest their money in the company. So basically, the cost of capital can be defined as a rate that must be earned by an organization or by a company at a given level of risk in order to satisfy its investors. It is a price, or we can say a cost, that the company needs to pay to the investors for the use of capital provided by them in financing the company's investment. So, cost of capital is a required rate of return that a firm must at least earn. It is the minimum required rate of return to cover the cost of raising funds from its investors. Investors, when they want to invest in certain company or in some companies, they're going to evaluate whether that company is able to pay them a minimum required rate of return in order to compensate the risk taken by investing in that firm's security. So this is the definition of cost of capital. And for cost of capital of a firm, it can be further categorized into three components. We have cost of common equity, and for this one, we're going to divide into two. We have internal cost of common equity. This one, we call it as KE. The second one, we have external cost of common equity. Cost of external common equity. This one, we're going to put it as K and E. The second type of cost of capital here, we're going to compute cost of preferred stock or the cost of preference share. So this one is KPS, preference share. The last group is the cost of debt, which we have the redeemable or irredeemable debt. Cost of debt is KD. We're going to look at each of these in details in further slide. Okay, from the cost of capital, now we're going to zoom in into the first component, which is the cost of equity. It is the annual return expected by ordinary shareholders in the form of dividends and share price growth. The ordinary shareholders' income is not solely based on dividend, but it is also came from capital gain, that is the share price. The share price growth is assumed to occur when shareholder expectations are raised about future dividend, whereby if the future dividend are expected to increase, the share price will also decrease over time. At any time, share price can be explained as a present value of all future dividend expectation. And for the cost of equity, we have two types, which is the internal and external common equity. And for this course, we are going to determine these two costs using two model, which is digital growth model and CAPM, capital asset pricing model. Now let's have a look at internal common equity first. Here we have KE. This is the rate of return required by the current common shareholders required on their investment that the firm obtained by retaining the earnings. Okay, so why do we assign a cost to the retained earning? Kenapa nak kena ada cost for the retained earnings? You have to remember that the common shareholders are the owner of the firm. So the company's profit should belong to them as well. However, this group of shareholders, the common shareholders, do not have any rights to determine how much exactly the profit that will be distributed to them. They need to wait for the firms to pay interest to the bondholders first and pay dividend to the preference shareholders, and if there are any excess of the net income, then the common shareholders will be pay a dividend. Okay, so all the excess of the net income can be distributed to the common shareholders as dividend, and they can themselves invest the money in other securities. They have alternative. The dividend that they receive from the firm, either they want to invest in that firm again, or they want to invest in other securities. However, if no dividend is paid, okay, common shareholders tak dapat dividend and all of the net income is being retained in the firm, The firm is actually using the shareholders' money to finance the future investment of the firm. Kiranya selepas dah bayar interest dekat bond holders, dah bayar dividend to the preference shareholders, firm decided not to declare or pay dividend to the common shareholders. They plan or they want to retain the excess of net income tu sebagai retained earning. Nak gunakan sebagai rolling modal untuk future investment. Therefore, the shareholders would expect the firm to give them returns at least equivalent to other investment somewhere else. We can say this as an opportunity cost of finance, which involve because it is the minimum return that required by the investors. If they do not get this return, they will transfer some or maybe all of their investment somewhere else. Logik lah kan? Kalau kita tak dapat minimum apa yang kita nak, we might consider to invest somewhere else. So here we can say that the reason to assign the cost to the retained earnings, kenapa nak kena cari the cost for internal common equity, it is to compensate the loss of future income on behalf of the common stockholders. Next is the cost of external common equity. It is the return that investors expect to achieve on their shares or investment in a firm. For example, if a company has insufficient funds to finance a project, the company could issue new shares as an alternative for additional funding. By doing so, the company will incur cost of external common equity, that is K&E. Okay, when a firm or company want to issue new common stock, it needs to incur flotation cost. What is flotation cost? It is the total cost incurred by a company in offering its securities to the public. So it can be in terms of brokerage fees, you need to pay some underwriting fees, legal fees, as well as registration fees. So sometimes the flotation cost will be mentioned as a issuance cost. Okay, so from this you can see that if the firm got the funding from retained earnings, there is no flotation cost. But when they want to issue new common equity or new common stock, they need to incur some flotation cost. That's why the cost of new common stock, K&E, will be slightly higher than the cost of retained earning, our KE, because of the existence of flotation costs. By now, you should have some ideas on what is common equity, what is the cost for internal common equity, KE, and cost of external common equity, KNE. But how do we determine them? We're going to estimate the cost of equity using two models. First one is the dividend growth model, DGM. This model estimates a cost of equity on the assumption that the market value of share is directly related to the expected future dividends from the share. So the assumption behind this model is that shareholders will expect dividend to increase year by year, which is the growth, and not to remain constant in perpetuity. So macam kita lah, kalau kita buat investment, kita harapkan the dividend akan naik daripada satu tahun ke tahun yang lagi satu. There should be some growth in it. Kalau tak, that investment nampak macam tak menguntungkan. Kena ada sedikit growth. The fundamental theory of share value stated that the market price of a share is the present value of the discounted future cash flows of revenues from the dividend. So dividend growth model is actually the relationship between the share price and the dividend as well as the growth rate. Okay. The relevant growth rate is the future growth rate anticipated by shareholders. Kita akan ambil berapa yang shareholders expect the dividend to grow for the next year. In the absence of specific information, like say the question doesn't mention anything about the growth rate, the future growth rate is assumed to be based on the past growth rate. So kita akan ambil je growth rate yang digunakan in the past in order to estimate the future growth rate. According to the dividend growth model, the market value of share price, the P, is given as an expected constant growth in dividend. So these are the formula to estimate the price. The stock price, PO, price for today, is the function of dividend in year 1 divided by cost of equity minus growth. So here is what we are talking about, the KE, the cost of internal internal common equity. Given the formula for dividend growth model, we're going to rearrange the formula for us to get the formula to calculate the cost of internal equity. From the previous slide, we rearranged it so we get KE, the cost of common internal equity, the cost of internal common equity, KE, equals to D0 dividend multiplied with 1 plus growth divided by the share, the market value of share, the price here, plus the G. G is growth. So this one, if the question specifically mentioned that dividend has been paid last year, you're going to use this formula to find the KE. But if the question say nothing in relation to the dividend, or maybe they say that the dividend is expected to pay next year, tak ada dividend yang dibayar lagi current year or previous year, we're going to use this formula, D1, which is the dividend in year 1, dividend in the future, over market value of share plus G. Okay, so this one is formula number 1, and this one is formula number 2 for this topic. Let us try to attempt 2 examples for us to be able to apply DGM formula to find the KE. Example 1, we have a share with a current market value of 96 ringgit. So this one is the PO. And the last dividend was 12 ringgit. The last dividend, meaning that this one is your DO, dividend that have been paid last year. If the expected annual growth rate of dividend is 4%, this one is our G. Calculate the cost of equity capital. Okay, so remember the formula for KE equals to DO multiplied with 1 plus G over PO plus G. Okay, put the figures into the formula. DO, we have RM 12 ringgit, 1 plus 0.04 divided by PO, I have RM 96 ringgit plus G is 0.04, and you should be able to get the KE of 0.17 or 17%. The cost of equity capital for this company is 17%. We will do the same for example 2. Ordinary share are currently selling at 30 ringgit per share. This one is PO. Last year, Precinct paid dividend 2 ringgit per share. 2 ringgit is DO, and it will grow at a constant rate of 8%. This one is G. Calculate the cost of equity capital. We can calculate KE equals to DO RM 2 ringgit, 1 plus growth 0.08 divided by market value of share RM 30 ringgit plus growth 0.08, then we can get KE of 0.152, or put it into percentage, 15.2%. This is how you calculate the cost of internal common equity using dividend growth model. Next, we want to look at the formula to find the cost of external common equity, KNE. Using the same model, dividend growth model, KNE equals to dividend in the year 0, 1 plus G, 1 plus growth, over NP. NP here is net price. Net price meaning that you have to take up the market price minus flotation cost. Remember, when the firm want to issue new share, they need to incur flotation cost. Okay, so this one we need to adjust for flotation cost to get the net price. After that, we're going to add with growth here. The formula is quite similar to KE. The difference only is this part. For the market value of share, we need to minus the flotation cost first to be able to determine the KNE. So this going to be formula number 3, and this one kalau tak ada dividend lagi pada tahun ni, dividend is expected to be paid next year, kita akan guna this formula nombor 4 ni untuk cari KNE. Alright, let's try 2 example to estimate KNE using DGM. Example number 3, company's share are valued at 5 ringgit as dividend. So this is the PO. Dividend grow at 6% per year. This is G. Current dividend is 50 cent. This one is your DO. Kenapa yang ni DO bukan D1? Sebabnya dia kata current dividend, bukannya future dividend. Okay. Flotation cost is 50 sen per share. Okay, sekarang kita nak cari KNE. We know that the formula for KNE is DO 1 plus G over net price. Then we're going to add G. DO, here we have RM 50 cent, 1 plus G is 0.06, divide by NP, price I have here RM 5 ringgit, minus with flotation cost RM 50 cent, then plus G 0.06. Lastly, we're going to have K and E of 0.1778 or 17.78%. Okay, beza dia hanyalah you perlu untuk tolak flotation cost here to get the net price. Okay, kita buat example 4 pula. Ordinary shares currently selling at 30 ringgit per share. This one is PO. Last year, Precinct paid dividend 2 ringgit per share. So, 2 ringgit is you punya DO sebab last year. It will grow at a constant rate of 8% per annum. This one is G. If the new ordinary shares to be issued, the flotation cost is 10% of the selling price. So 10% of the selling price, kita tahu 10% daripada selling price dia RM30. Jadinya flotation cost dia adalah RM3. Okay, put it in the formula for K and E. DO I have RM 2 ringgit. 1 plus G 0.08 over net price. Market price is 30 ringgit minus flotation cost 3 ringgit. And then kita akan tambah dengan growth 0.08 dan I akan dapat K and E untuk Precinct ni sebanyak 0.16 or 16%. The cost of external common equity for this company is 16%. Next, we're going to estimate the cost of equity using the second model, which is capital asset pricing model. And I hope that you still remember that for CAPM, it is based on the comparison of the systematic risk of individual investment with the risk of all shares in the market. Okay, so CAPM ni kita boleh juga guna bila kita nak kira cost of equity when the project risk is different from that of the company's normal business risk. For example, maybe sekarang you are in hotel and tourism industry, lepas tu tiba-tiba you rasa nak buat new project, new venture, maybe in plantation industry. So kita punya risk sekarang, existing risk tak sama dengan the next project yang kita nak undertake tu. So bila ada that kind of situation, you boleh guna CAPM untuk estimate the cost of equity for the new project. And you should still ingatlah macam mana formula nak cari required rate of return RI or kita punya KE, the cost of equity, using CAPM. We have risk-free return RF plus beta, and risk premium is RM, return for market, minus RF. This is formula number 5 for this topic. Okay, as you are familiar with CAPM, I will let you to do example 5 and example 6 by your own, and maybe we're going to just recheck or reconfirm the answers in our class discussion. That's all for this part. I'm going to continue with the cost for preference shares in the next video. Thank you.